So welcome to the 12th lecture then in Energy and Finance. So we're going to continue our exploration of sequential investments. So we're going to look today at continuous investments. So remember last time we have been looking at a finite number of stages. So we were exploring this paper by C.T.J and Maribou, which had two sequential decisions. So this that made for one endgame in which the plan is finalized, and there's some intermediate stage where you have made your first investment in capacity, but you still have the option to upgrade your plant, adding capacity to get to your endgame. And we were solving this by backward induction. We had an initial stage, basically a greenfield stage, in which we looked at the value of this option to invest in the first part. So investing in the first part means you get the baseload plant, but you also get the option to make the second investment in the peak load plant with additional capacity. So now you might wonder, of course, why should you stop after two decisions? So in practice, often there's many decisions. So if the market keeps growing, or if your demand keeps growing, you might want to expand your plant further. So today we're going to explore a paper by Pindijk, so the same person who co-wrote the book that you have with Dixit, in which he actually looks at a model of continuous expansion of capacity. So there is no natural endpoint here, so there's no natural point at which you would stop basically investing. There's always the opportunity to keep on adding capacity to your plant, to your firm, as demand grows further. So the goal for today, or the two goals for today, are basically, first of all, to answer the technical question. So how should we solve such a real option problem in which there is essentially not a natural endpoint, so we can keep on going and invest in adding capacity. We can keep expanding our capacity without any endpoint as long as demand keeps on growing. So we cannot actually use that backward induction methodology that we looked at last time. So the second question that we want to have a look at is the economic implications. And that basically asks, so how do firms grow in practice? Would firms indeed grow by smoothly keeping on adding capacity all the time, or are there some periods in which there is no investment, and then perhaps again short periods in which this firm grows perhaps at a higher pace? So, or in other words, what determines this growth, or when does the firm add capacity? And also, for many firms, so particularly not called without a reason growth firms, like the tech firms, the pharma firms, they tend to grow a lot in the future, and in particular they also tend to derive a large part of their value from their opportunity, or from their potential for future growth. So in particular, the value of the growth option in these growth firms might be fairly large, might even be larger than the value of those assets that are at this point in time in place. So we are going to ask in this particular model of Pindijk's, what part of firm value do we see there that growth options play in explaining the total value of this particular firm, and how can we relate that to these firms that we see in practice that depend a lot on growth options. So again, we have a look at this paper by Pindijk, and what Pindijk does is he looks at a monopolist. So a market with a monopolist. And what this monopolist does is, well, first of all, it does what monopolists do, so it maximizes its profits by choosing the quantity of goods that it's going to sell into this market, like you know from your monopoly analysis that you learned in your microeconomics courses. And it can also actually expand its capacity to produce. So in this case, both price is endogenous, so it's determined by the choices in terms of the quantity that the monopolist is going to put into the market. And that's a choice by the monopolist, so it's not an exogenous thing. Price is not exogenous, it's determined by the monopolist itself. And also capacity is chosen by the monopolist itself in response to what happens outside as exogenous evolutions. So what is exogenous here? Well, what we're going to choose here is the size of demand, theta. So, to make this sort of a bit clearer, so what we have here is some demand function, or rather an inverse demand function, P equals theta times Q to the power minus gamma. So P, of course, is the price that's going to prevail in the market at some point in time. Q is, of course, going to be the quantity that this monopoly is going to produce in this market, and as price or demand equations go, this is going to be a downward sloping thing. So the larger Q is, the lower price gets. So this gamma parameter here is a number that's going to be positive, and actually I'm going to choose gamma here between 0 and 1. And in particular, this functional form of demand is known as constant elasticity demand. And this gamma actually plays a role, and you might want to verify this, it plays the role of the inverse elasticity of demand here. So what is theta doing here? So theta is going to be essentially a demand shifter. So as theta grows, the total demand function is going to go up, and if theta declines, the total demand function is going to go down a bit. Or in other words, the same quantity that I produce, the price that I will get, so when this demand function brings me, is going to be lower or higher depending on this size of demand theta, or the size of the market theta. So this theta is going to be, this exogenous parameter is going to evolve according to some geometric Brownian motion again. So d theta is given by, well, this is drift part, is the growth part, mu is going to be the growth rate of theta, again the exponential growth rate, and sigma, of course, here again represents the volatility of this process. So what's going to happen here is, for this monopolist, is going to observe what is the size of demand, what is my demand form today, this year, and then it's going to choose how much quantity this firm is going to produce, how much goods this firm is going to produce into this market, sell into this market. And of course, as things go, quantity is going to determine prices here. So the total amount of quantity is going to then determine what's the price going to be in this market. So you can think again, theta is the market size, demand size, and that might be driven, say, by total economic growth, but that's not under the influence directly of this monopolist, or perhaps by demographic changes in this market. So this firm is going to choose its quantity at each point in time, each day, or each year, in order to maximize its profits. But in order to actually also introduce our real option problem, we also want to have a look at the role that are played by investments here. So we have this price demand function here, this constant elasticity demand. But we're going to assume that this monopolist has certain factories, right? Certain plants. So if it's a power producer, it has some power generation plants, and these power generation plants will have some capacity. We'll call that capacity K. So that will be a number of megawatts, right? It's a number of megawatt hours that you can produce each hour. Essentially, that's what megawatts are. So what that's going to determine, this K, is the maximum amount of quantity, maximum amount of energy that I can produce any given hour. So this Q is going to be limited by the total capacity that I can produce. So if I'm the monopolist, I can choose to produce any quantity of power to produce in any given time, up to the total capacity that I have, which is K. Now, as demand grows, so as this theta parameter grows, I might like to be able to produce a little bit more, produce more than my capacity. Well, what do I need to do? Well, I need to expand my capacity, right? I need to expand K. I need to build a new power plant, for instance. Well, what does that mean? Well, I can expand my capacity K, but for that I need to sink some investment cost. So I'm going to call the per unit cost of investment in expanding my capacity, I'm going to call that I for investment. So if I want to add an amount of capacity delta K, that's going to cost me an amount of I times this delta K. So I is a per unit cost, so I times delta K is the total amount of money that I need to spend to add this delta K to my total capacity. So now if I'm this firm, this monopolist, I face this real option question. And the real option question is, as this demand size theta, as that grows over time, according to this stochastic process, so it's an expected growth, right? There might be downturns as well, so it's volatile. But how fast should I then, as a firm, expand my capacity? At what moments and how fast should I then add capacity to the plants that I already have in my total power generation portfolio? So before I can answer that, I first have to deal with the monopoly problem. So at any given point in time when my capacity is fixed, so it's just the number of megawatts that I have at my disposal, I have to choose, well, how much quantity am I going to produce and am I going to sell into this market? Well, I cannot produce more than my capacity, but I could produce less. So, well, what's the optimal amount of quantity that I'm going to produce? So what I want to do is I want to maximize my profits at this point in time, say this hour in time, this day in time, given the demand size theta that I observe for today, right? So this theta is moving up and down, but today I observe theta to be some level, demand size to be some level. How am I going to choose my Q, my quantity? Well, I want to choose my Q so as to maximize this profit. So what are my profits? Well, they are revenues. They're the revenues P times Q, where this P actually was given by this demand form, right? It was this theta times Q to the power minus gamma. That was the demand equation. So you note here, in general, you might also have some production costs here. So you might want to add minus C times Q. I'm going to ignore that. So I'm going to look at an industry in which actually the variable cost, the marginal cost of production, C times Q, are actually negligible compared to these investment costs of adding new capacity, this I, which is fixed for this particular day, right? So I'm not going to add capacity this particular day. So I'm going to ignore any, just to make life simpler, we just have the revenues here, P times Q. So again, using our demand form, P equals theta times Q to the power minus gamma. I will multiply that P times Q, then I get what's over here, theta times Q to the power 1 times Q to the power minus gamma. Or in other words, theta times Q to the power 1 minus gamma. I want to maximize this. So how do I maximize this? Well, I need to choose my Q to make this profits optimal. So let's have a look actually at the derivative of these profits. Well, if you take the derivative of this with respect to Q, what's going to happen is the 1 minus gamma is going to end up in front of this function, and the exponent is going to go down by 1. So you will get theta times Q to the power minus gamma, multiplied by this 1 minus gamma up front, this factor that came down. And if we think about this a bit, well, all these factors are actually positive. So gamma was a number between 0 and 1, remember, we chose that. So 1 minus gamma is also between 0 and 1, so it's positive. So theta is a positive number, is demand size. And Q is a quantity that I'm going to produce, also positive. So the derivative of profits with respect to quantity is always positive. So if I want to maximize my profits, what am I going to do? Well, the more I produce, the larger Q is, the larger my profits get. That's what a positive derivative means. So I'm going to choose my Q as large as I can. Well, how large is that? Well, I would like to go to infinity, but I can't. I have this limit. I only have a certain capacity of power plants K here at my disposal. So what am I going to do? I'm always going to actually choose in this model to set the total quantity that I'm producing equal to the total capacity that I have. So that's what's happening when C equals 0, when my marginal cost of production is 0, it's no variable cost of production. and when this demand form is indeed of this particular constant elasticity choice. So if you look at different demand forms, so linear demand, and if you do include variable cost, then it might sometimes pay actually to produce a little bit less than capacity, and that's actually what Pindike does. So have a look at what Pindike does. He analyzes linear demand, and he analyzes the case with past and marginal costs, and there sometimes it's going to pay if you want to maximize your profits on this particular given day. Going to pay to leave some of your capacity unused, and that's going to have some implications, and I invite you to actually have a look at that. And the kind of analysis that he does should be somewhat familiar to what we had actually in this case in the analysis that we did by Murto and Nasa, which sometimes the plant, or in this case part of the plant, its operation might be suspended for a bit. Okay, but so we are not doing that over here, so I'm making life simpler for us here. So we only have, we always, in this particular model, due to this choice of demand form and this choice of leaving out any marginal cost of production, we are always producing up to capacity, so Q equals K, so it makes life a bit easier for us. So the next thing that we will want to do is, I'm going to do here at least, is I want to have a look at the static benchmark. So I'm first going to ignore the fact that theta is going to move up and down. So it's stochastic. I first want to make the analysis. What's going to happen here? What would happen for a firm which has a fixed demand size? So theta is a fixed number. How much capacity would it invest in? So that's the static benchmark that's up next.